Tuesday morning racing series. See if we can get these slides moving. This will be a 2-hour CE class on know what every realtor should know about the loan process. And for those of you who just joined us, it is a 2-hour CE class. The rules by the division are, of course, that you must have your full name displayed on the screen, video turned on, be in attendance for the whole of the class, be seen and engaged throughout the class. Hopefully we'll do that with each other and learn from each other. And I'll give you 3 keywords, and this little icon, this poodle icon pops up. That's Merlin, our little poodle, and the keyword will flash on the screen. Let me just get this going. Here we go. So Raising the Bar series, there's 12 classes in this series by Presidio. Jennifer Yo is our owner, principal broker of Presidio Real Estate. She said this: doing the right thing in every area of our jobs only makes the industry better as a whole. Staying committed to that helps us all have a strong, resilient, long-lasting career, and will bring more referrals and business to you than you can ever imagine. That's why at Presidio we all pledge to raise the bar. And irrespective of which brokerage we're with today, I encourage you to raise the bar. Be a little bit better today than we were yesterday. Better this week than we were last week. Better this month than we were last month. And better this year than we were last year. As we do that, we will increase the standard and practice of realtors within this industry. An interesting quote I found here from this American poet, Robert Lee Frost. He said, "A bank is a place where they lend you an umbrella in fair weather and ask for it back when it begins to rain." I thought that was a funny little quote there, which is quite applicable to this this lesson. So let's have a look and see what we can learn. Today we'll talk about what a realtor should know about the loan process. And of course, most of our clients, most of them are buying a mortgage property, which means they don't have the cash to buy the property right out. They've got to go somewhere to have someone lend them the money. So let's see if we can figure out how we might better serve and prime our clients to be placed so that they can get ownership of the home by getting a loan. We'll try and cover the following. We'll talk about the loan process. We'll review some of the areas that we may or may not be aware of with regards to getting our credit score good, and then we'll review at the end of the class some do's and don'ts that might be helpful. Please just unmute and chime in with any questions you have or any comments or stories or experiences you'd like to share. I will not respond to chat. Leslie Ann will respond to chat, but I'm really pleased if you can just unmute and just chime in, just interrupt me, because I want to hear from you, and I'll try and engage as many of you as I possibly can as we go over the next couple of hours. I believe irrespective of how long we've been in this industry, we can all learn, and we can learn from each other. We do have some new agents on this class, and they will be very grateful for those of you who are seasoned realtors to share with them your experiences and your knowledge, particularly as folk that have been in the industry for a long time. We've seen lots of things as we've worked with clients in real estate. So we'll talk about the loan process first. Obviously, we've got to have a conversation with a loan officer sooner or later. We'll talk about the loan application, the initial disclosures, some of the documents that are needed, review the first round of underwriting, ordering the appraisal, right up to the final round of underwriting, finishing up with the closing documents and signing with title, and closing disclosure, and of course, the funding. That's what we'll try and get through in this next hour or so. So obviously, we want to have a conversation with a loan officer, but there are some of us who have only just joined this industry. And so here's a thought. Firstly, do you have a loan officer that you can recommend to your client if they do not have one? So if you're just joined this industry, you don't have someone you're currently working with, I encourage you to connect with another fellow realtor, or certainly talk to your broker or your mentor, and they should be able to help you with some possible loan officers that they've used that they can recommend. Here are some thoughts you may consider when looking for a loan officer. And sometimes, you'll have a realtor that will actually meet with some loan officers to find out if they get along well and if they have the right sort of chemistry to work together on a transaction. So you may ask some of these questions. What types of home loans do you offer? What are your closing costs? How much time do you need to complete a loan? Is your underwriting department in-house? Is there a charge for an interest rate lock? And how do you work with your clients? So some questions you might consider. Let's pause there for a moment and ask anybody to respond on any thoughts that may be related to that slide or anything you might add to. Let me pull in Tristan. Tristan, how are you today? We've had a chat before. Good to have you with us today. How are you doing?
Oh, Stephen, I am blessed and highly favored, my friend. How are you?
Good. Good to have you with us today. Do you have some loan officers that you currently work with, Tristan?
Oh, I have several of them. I have a lot of brokers. And what I like about brokers is they can shop my clients' information around to several different lenders and find the right program that works for them.
Well, notice Tristan said he has several of them. What are some of the reasons why we might have several options here? Not only for the different packages they have, but what else might we consider, Tristan, when you're trying to recommend a certain type of person to visit or work with your client?
I definitely take their personality into account, right? If I'm working with a client who is very playful, I've got a particular lender that I would send them to. And I also have escrow officers, going a little off topic, that I would recommend also, just to kind of match their personality.
Perfect. Absolutely perfect. Yeah, we've got to try and match them up, because if you've got a couple of folk that are maybe very professional, you may have a very professional loan officer, but if the chemistry isn't going to be right with your client, it may not work. It may not run the course. So very, very good to highlight that, Tristan. I know we have a few different loan officers, and at one time we had two that are totally extremes. One was very, very businesslike. I mean, very, very good, very sharp, very efficient, very responsive. I mean, he was just on the mark all the time, but maybe a little bit abrupt here and there, because he was, sort of directive, but he could definitely get the products done. And we had another loan officer who was completely at the other end of the scale, very soft, very gentle, very, very patient. And we would find sometimes we'd have a client that needed the business type guy, and other times, we had a client that just would not have survived with him, and they needed the softer approach. So matching up your lender with your client is very, very important, very, very important in this. So anybody got any stories or experiences like to share where they have either successfully or unsuccessfully matched up a lender with a buyer that they'd like to share? Okay, I'm going to bring in Marilyn. Marilyn, how are you today? Can you hear me okay? Can you unmute? Tell us how long you've been a realtor for. Oh, you just muted. You have to unmute. Just click that button again. There you go. There you go.
I had it. Okay.
Wonderful. How long have you been a realtor for?
Yes.
Yeah.
How long have I been? Oh,
yeah, how long?
15, 16 years.
You're perfect to ask this question then, because you've probably seen this go wrong once or twice. Have you ever had an experience where you've seen a little bit of, I don't know, a friction or a bumpy ride between a lender and your client?
I have, in fact, just recently, and the problem is my client was kind of a problem person too. So
sometimes we've had that, yes.
Yeah. So my client would complain about the loan officer, and that she was being pushed off to an assistant and wasn't getting things answered, and all the things she was sending to him wasn't coming. I wasn't sure who to blame and who to trust.
Right.
So I'm actually looking for some new loan officers.
Okay. Well, I'm glad you shared that, Marilyn, because sometimes it is our client that is the challenge. And so the better we know our client, the better able we are to match up a lender that's going to be patient enough to help them through the process. It's really important that we have this match as best as we can, because if we don't, it will be a bumpy ride. And, one person will get frustrated with the other. And of course, the loan officer will continually be asking for more information. And sometimes that can be a little frustrating with a client that's not expecting that. So certainly when we are working with a client, it's an ideal platform for us to sort of forewarn them, help them understand that this will be a continual process, but the lender wants to get you the money. That's what I say. So I say, hey, this lender actually wants to give you the money. That's why they've got to have all of this information. Any other thoughts on that, Marilyn, you'd like to share?
For me, no. Thank you.
Well, thank you for sharing that as well anyway. So let's look at some thoughts here. When you get your client to meet with a loan officer, there are going to be some things that this loan officer is going to go through. They're going to obviously generally speak about creditworthiness in that initial meeting. Obviously, the loan officer will have a certain amount of products or packages in their mind that may think will fit this client. They will establish some expectations, and of course they will then discuss some finance options that may be available to your client. This can be done over the phone, or sometimes it can be done even better if it's a meeting, either over lunch somewhere or even at the office of the loan officer. But it's really good that you have this initial meeting with the loan officer, meeting with your client. Anybody got any other comments or observations on that slide they'd like to share? Very good. That brings us up to our first keyword, which should just come up on the screen any moment. It shall be finance. Okay, F-I-N-A-N-C-E. The word is finance. That should be shouting up on your screen. Finance, F-I-N-A-N-C-E. Write that down. That'll be your first keyword. I will not mention that keyword again, and we're not allowed to share it in the chat. If for some reason someone misses a keyword, then please privately text a message at Leslie Ann, and she'll be able to help you.
I did just share the link in the chat. The chat is along the bottom. Sometimes when you're not hovering, the icons along the bottom of your screen disappear. And Emily did join us. Emily, I did send you a chat note. Maybe you didn't see it, but just to let you know, if you want credit for this class, I need to be able to see you. I just see your name. If you don't want credit, you are good. So you have to be virtually live, not a name or an image. So just letting you know. And it does appear that Gilda left the class, Steve, if you're looking out to ask any questions. So
thank you.
Okay.
Thank you, Leslie Ann. So finance, that's the first keyword. And off we go. So let's look at 8 types of mortgage loans. These are the general loan types that we hopefully will be familiar with. We'll start off with that 30-year fixed rate mortgage. And let's see if we can bring in Sarah. Sarah, would you like to unmute? Say hello to everybody.
Hi, how are you?
Good. How long have you been a realtor for?
Let's see, I got my license in 2020, so not too long.
That's great. You're in the first wave, of action. Good for you.
Yeah.
So can you tell us what you know about the 30-year fixed mortgage?
A 30-year fixed rate mortgage. It just depends on your credit worthiness. I don't know a whole lot about it.
Good. Well, that's good. We can have a little chat then. So it is the most popular. I'll put that on the screen there. The good thing about this this product is the interest rate will not change. It will just remain the same, okay, for the period of time. And of course, it's going to be a lower monthly payment than a shorter term loan. It is the most popular. Most of us are dealing with 30-year fixed mortgage rates, and all of the loan companies, have some really good product platforms that they can share on this. And of course, the general interest rate at the moment is pretty low, and so this is quite popular. Very good. Let's move on to the next one. Okay, and this one is the 15-year. And while you're still with me, Sarah, this is more or less the same. There is going to be a difference on one of the items, and of course this will be a better interest rate because you're only running for 15 years. Usually people use this mortgage for refinancing. Sometimes that can be a challenge for us as realtors when we try to actually buy homes, because sometimes there'll be a bottleneck with the loan companies because they've got so many refinance products going on, and they're dealing with those clients as well. So sometimes we can see a bit of a bottleneck on that. And basically, there are other things more or less the same. Obviously, you're going to have it paid off quicker, and you won't pay as much interest. Any questions on those two products? So there's the or two terms, the 30-year or the 15-year fixed rate mortgage.
So the rate that they get, it does depend on their credit score and all those other factors, right? So I always just defer to the loan officer, just say, there's a lot of variables. That's their wheelhouse. I try.
We're going to look at some of those more detailed questions on how we can get those credit scores up a bit later on in this class. But yes, the loan officer is key here. They are selling these products all the time. They know the different clients. They know what clients can qualify for. And yes, even though generally speaking the interest rates are low at the moment, there is going to be a little bit of movement as to how low the client can get them, dependent on how well their credit score is.
And it depends on whether it's conventional or an FHA or all those different kinds of products too, right?
Yes, and we'll look at those in a few moments. So yeah, thanks for raising that. Let's move on to the adjustable rate mortgage. Maybe I could bring in, let's see, Christina, would you like to chime in on this one? Just unmute and say hi to everybody. Let's see if Christina can say hello to me. Is Christina still with us? Maybe not.
Sorry, I'm here.
She's there. Wonderful. Okay, Christina, tell me.
I'm having some issues with everything in here.
That's all right. It's good for me to connect people. I can at least see that your mics are working and we're engaged. So have you come across this adjustable rate mortgage, Christina?
I did years ago, and it's just nothing that I really try to talk anybody into getting. Just because they keep changing, your prices change all the time.
Perfect. Anybody here like to help Christina on what are some of the benefits that we would see with an adjustable rate mortgage? Anybody dealt with these recently or in the past?
And I guess I should say I usually work with first-time buyers, so.
Okay. So I'll put some notes up there for you. Great for buyers that don't plan on having a mortgage for a long time, because obviously the adjustable rate's going up and down. Initial rate fixed for a specified period. Initial rates often locked for 1, 5, 7, or 10 years. Obviously, they're going to get a lower interest rate than those with long-term loans. So that's what the adjustable rate mortgage is. Let's go to this one here. And I think it was Sarah that mentioned the FHA mortgage. Let's bring in, let's see, Tammy, would you like to chime in on this one? Tammy's been with us before. I know she can help us a little bit on this. Are you there, Tammy?
Yes, FHA mortgages.
Yeah, talk to us about FHA mortgages.
Federal Housing Administration does them. I don't know much about them.
Well, the great thing about these, Tammy, is we have got a nice low interest rate. So for first-time buyers, which I think Christina said she does a lot of first-time buyers, you're probably going to find this one being the most attractive. And they can get scores as low as down as 500, believe it or not. Some companies can get them that low. So these are quite a nice package for people that, you know, have got a tight income band because the down payment is as low as 3.5%. Any other thoughts or comments on the FHA mortgage?
Yeah, the down. Oh, go ahead.
Yes, go ahead. Thank you.
It just looks like it helps people also who doesn't have good credit scores.
Yeah. Yeah.
Are these just for first-time home buyers, or can anybody apply?
They're great for first-time buyers. Is that Kaylin speaking?
Yes. So if you're
thank you.
not a first-time home buyer, can you still get an FHA loan?
Of course you can. Absolutely.
Oh, you can.
Yeah, absolutely. Yeah. You know, it's usually good for people that may not have the capital to put down 20%. You know, 20% for conventional loan. That's often what they need. And if they haven't got that down payment, this 3.5% down payment is very attractive to them. So anybody can get them, but often first-time home buyers are locking into these first because they are, you know, more affordable. Thanks for that, Karen. Thanks for that question. You do have to have the mortgage in premium payments for these. There will be some mortgage insurance premium that is required for that 3.5% down payment. Let's go to the VA mortgage. Anybody here had any experience with VA mortgage? Let's see if we bring in Steve. Steve, you want to unmute and say hello to everybody?
Hello.
How
Yes.
you doing, Steve? Can you talk to us about the VA mortgage?
Yeah, I've done a few of those.
Okay, great.
Yeah, it's just 100%. No down payment required on them. No mortgage insurance.
Yeah.
They're a little
These are
harder.
really good.
They are. They're really good. They're hard to get done right now, though.
Right.
In this
Do you
market.
know why? Do you know why they're hard to get done at the moment, Steve?
Yeah, because everybody's bidding up everything out there right now, and the VA is not going to support that.
Right. Yeah, these are a great product, but obviously offered by the Department of Veteran Affairs program. The great thing is, of course, no down payment, no mortgage insurance, and of course, there will be a little, well, it's usually a substantial fee for the upfront funding fee. So just be aware of that. Other than that, these are great packages, great packages.
So Steve, is that because the VA has their own appraisal? They have their own appraisers. So yeah, they're less likely to.
Yeah, the VA appraisals are just a little bit, and in this last 2 years, it's just been really hard to get one to come in at where the purchase prices are when everybody's just trying to get into a home.
Yeah. Okay. Very good. Thank you, Steve, for your help there. Thanks for that question, Sarah. So let me go to the USDA mortgage. Anybody had any experience working with USDA mortgages? Let's see, we've not heard from, what about Lee? Do you fancy chiming in on this one? Let's see if I can get Lee to say hi to everybody.
Les, are you asking me?
Yeah, how are you, Lee? Have you ever dealt with a USDA mortgage?
Steve, it's Les, not Lee.
Oh, it's Les. I got down Lee. Sorry. Thank you, Les.
I've done a little bit with it. I mean, right now it's obviously very difficult to get them because of the same thing with the, generally the people who are going for these mortgages don't have $50,000 that they can put in to go above and beyond the appraisal value. So, but it's really common in the small rural areas that, the government's trying to promote growth in, and so they give you the, no down payment, 100% financing.
Yeah, perfect. Of course, the USDA stands for Rural Development, the Housing, the United States Department of Agriculture, which is under the direction of the Rural Development Housing Loan Program. No down payment, which is very attractive. They have to live in the actual area that these loans can operate in. The loan company does have to have the ability to sell these products. Some loan companies don't specialize in these. I put a note down there, income limits and property value caps apply. Only the borrower and their immediate family may live in the residence. And you've got a time period as well. You have about a 60-day time limit to move in and live in the property throughout the term of the loan. So that's what you're really working with on those USDA mortgages, which are very attractive in the rural areas, as Les just mentioned. We go up to number 7, which is the jumbo mortgage. Anybody had experience with the jumbo mortgage? We've not heard from Lillian. Do you fancy chiming in on this one? Any idea on the jumbo mortgage? Let's see if I can get Lillian to say hi to me.
I've never worked with that. I've only done conventional FHA, so I don't know.
Okay, so these jumbos, you've got to have a bit of money to do these. So obviously you're looking at a really nice credit score of 700 and above. They can be fixed or they can be adjustable rates. Usually buyers who are looking at buying, you know, high-end homes often refinance with the jumbo. They quite like that. Usually requires a down payment of 10%. For 2021, the conforming loan limit was 548,250. So that goes up each year. I think last year it was like 510,000 something or other. So it's probably gone up another, whatever it is, you know, 30, 40,000 this year. So that keeps going up. But basically the jumbo loan is anything over that amount. Let's finish up with this last one here, which is the interest-only mortgage. Anybody have any experience with interest-only mortgage, and what benefits are these? So have we not heard from Taylor? Do you want to chime in on that one? Any experience on this one, Taylor? Let's see if I can get her to say hello to me, or him to say hello. I can't see everybody's face, you see. Is Taylor still with us? Maybe not. Emily, are you with us still? Emily or Taylor, either one of you want to chime? No, maybe I lost those two. I don't see everybody on the sheet. I'm supposed to engage everybody. All right then. Well, interest-only mortgage is basically what it says. Borrowers with large cash flows, savings income, bonuses like interest only, because they pay down the principal balance when they want to. They just pay in basically the interest. You have to be a disciplined borrower for one of these. Useful for buyers who probably are not interested in staying in the home for too long, and usually requires substantial assets for the lender to review and approve those. So they're the sort of 8 general types of mortgage loans that we may come across in this industry. Okay, let's look at some terms here. You'll come up with this term, which is conventional mortgage. And basically these are loans that are not backed by the government. Okay. And we've got the conforming loans, which of course meets local limits set by the government. And we've got the reverse mortgage. We'll talk about that in a moment. And then we've got the government-backed mortgages, which are those we just looked at, which is the VA and the FHA and the USDA. Let's talk about reverse mortgage. Who can tell me a little bit about reverse mortgages? How these operate? All right. Who we not heard from today? Let's see if I've got everybody involved in this. Just about, maybe. Let's have Tristan. Tristan's got some experience. He'll be able to talk to us about reverse mortgage. Tristan, why don't you jump in on this one? Tell us what you know about reverse mortgages.
I know reverse mortgages, they are often beneficial for people of, say, retirement age, right? They're cashing in the equity of the home that they own for a reverse mortgage.
Perfect. So just be aware that there are some high fees initially when you're working on those reverse mortgages. And I think that's because they want to make sure they get the money early on. So just be aware of that. But they are really good products for those that want to release some cash, some stream of income to pay off that mortgage. So, but just be aware that there are some high fees up front on those. Any other questions on any of those terms? All right. Let's tootle on. So let's look at this. Initial disclosures. When you're working with your client, there are going to be some things that they're going to have to do, and they need to be aware that got to be transparent throughout this process. I'll load these in and then we'll just talk about them because this will vary from one person to another. The loan officer will come up fairly quickly with an estimate. They'll figure out roughly whether or not they can work with this client and give them the money that they are looking for to buy a home. And they'll say, yeah, I think we can do this using this product. This is roughly how this will pan out. They'll do this before they start to really dig deep and build a file. This will be done before underwriting, be done before the appraisal. During this time, the loan officer will explain all of the costs and fees that will be with the package that they're going to be hopefully running with. And if the client is considering to use Bitcoin, this is a good time to tell your loan officer, because they will need to know how to handle that early on. Anybody dealt with Bitcoin for down payments or collateral? Obviously, it can be used, but you just got to make sure that your loan company is aware that your client is, or your client is aware that they are thinking of pulling money from Bitcoin. Okay, let's move on. Documents, lots of documents will be needed. Of course, W-2s, pay stubs, bank statements, employment history, and of course, if you're self-employed, you're going to need a couple of years of accounts there. Let's pause there for a moment and have a little chat about this. So anybody here like to share any stories or experiences they've had when they're working with a client who's self-employed, and we've got to get those 2 years of accounts to our loan officer? Les, how about you chiming in? If you have any experience where you've dealt with a client who's self-employed looking for a loan. Les, are you able to help me on that one?
Yeah, with the self-employed, definitely hope that you're working with a great lender at that time, because it can be a little bit more stressful for, you know, to get that approval going, especially if your client isn't the most organized. Usually if you got a client that's only been in business for 3 or 4 years, it's going to be pretty stressful for that loan process.
Yeah, I'm glad you raised that, Les, and keep talking to me on this. What are some of the stress pains that you're going to possibly be dealing with when you're working with a self-employed person? You've already highlighted at least trying to get all that paperwork together, because sometimes they're not as organized, you know, just because they're busy, you know, working the job. Talk to me about how this process may be quite difficult working with a client like that.
Rarely are you going to have any W-2s. It's all going to be through disbursements to the owners of the company, and many people just run their business account as their personal account, and so it gets pretty messy to see what actually was profit and what was not profit on it.
Yeah, and sometimes it crosses different bank accounts, because they will pay from an account which could be their personal account, because the business account is maybe empty, and you've got all that cross-pollination of work. This has to be, hopefully it's been sorted out with the accountant that's been working with them, but often the paperwork can be a little bit messy, and if the detail in the accounts is not clear, sometimes the loan officer will ask for extra information. Yes? Yeah, very good. Thanks for sharing that. Has anybody else got any questions or thoughts or comments when you're dealing with self-employed people who are looking at getting a mortgage? Marilyn, how about you, chime in? You're experienced. You must have come across a few folk that have found difficulty in supplying all the documents that are needed for them to get a home. Would you like to comment?
I don't know. I've just worked with some that, not that it's their own business, but they just are starting out with a new employer, and that's been really difficult. Trying to verify their wages and, you know, what they can document as far as their earnings, especially in these times right now. Yeah,
definitely. If they're thinking of changing employment, don't do it while they're getting a loan. Stay where they are. And if they have just changed employment, usually the loan, if it's an employed platform, the loan company is okay with a 30-day period, so they can get those first set of pay stubs in.
And isn't that usually they require at least 2 years again, that they have to be?
If it's employed, they can usually work on, as long as the person's been employed previously, it's absolutely right, yes. But if they've been employed previously for years and then they've moved employment and now they're with a new employer, but they've just started with a new employer, often the loan officer will want that first 30 days with the new employer before they can start to log those pay stubs. The previous logging will be fine. If they have not been employed and they've just got a job, and depending on what loan company is and depending on what product is, sometimes they can still get a mortgage as long as they get the first month pay stubs and they get maybe a letter from the employer that might qualify them into a contract. That person's going to be in there for a period of time. So it does depend on the loan company, but you are right in saying these loan companies are keen to see the history of the person earning money. And certainly if they're self-employed, they've got to have the 2 years accounts. You can't get away from that.
I've had loan officers request a letter of verification of employment from the employer if they're new, and pay stubs. But that's all they need.
That's correct. And often, as long as they've got that job and they've had it for a month, they've got the pay stubs and they're employed and they've got that letter, then often they can get that mortgage through the hoops.
Yeah, better look for the lender.
Yeah, very good. All right, let's move on. Now, depending on which company you're working with, and there is a difference when you're working with a bank to give you a mortgage against working with a mortgage company, a private company. Banks do lots of things. Mortgages is one of the things they do. So they don't specialize in mortgages. They do great products as long as you can check all the boxes off and you fit the package. Whereas a private loan company that all they do is mortgages, they've usually got a bit more flexibility and you probably end up moving quicker with them. I mention that because the first round of underwriting could be the first round of many rounds of underwriting if you're with a bank, whereas if you're with a private company, often you can be just a few rounds of underwriting, or even just the first round and the final round, depending on how the package is presented. So here are some thoughts you may consider when you're working for that first round of underwriting. So based on the documents that they get back from their checklist, and each underwriter will have a different, I guess, checklist that they're trying to get items that they'll crunch the numbers out and they'll say, yes, we can make this work. We've looked at the credit rating, we've looked at, all the bits and pieces that fit this package, and we're confident we can make this work based on the information we have at the moment, which is not everything. We just have a bit of the information, and usually they can come up with an answer within a few days. They will also, this first round of underwriting, will mention some of the conditions that are going to be requested to make this package run, and they'll be putting in there a number of line items that the client has got to come up with. And if there are some deal breakers, they'll be revealed at this stage. So, we can only do this if you can get, X, Y, Z. So that's the first round of underwriting. Any questions or comments on that? It's just kind of like the first hit. You can usually get an answer within a week from your loan company. Once they get going, they're going to be asking your client for lots of things. It will just be a continual flow of information being requested by the loan officer. You'll find that your client will get bombarded with a lot of requests from your loan officer because he or she has got to make this thing work. We'll get to the stage where they're going to order the appraisal, which will be ordered through a third party, just as we've got new clients on today. Let me bring in Liberty. Liberty, have you come across this word appraisal before? And if so, can you tell us what you understand the appraisal to be?
Yeah, so it's like seeing how much the house is worth by bringing in like a actual licensed appraiser to go through their checklist and get the value of the home.
Perfect. Yes. So as Liberty said, the appraiser will have a license. He's a licensed appraiser. He's part of the the appraisal platform, that a company may have a group of appraisers that they lock into. They won't know which appraiser's going out, right? But they may have a dozen appraisers that tend to look after their company, and they'll know one of those is going. But they can't choose them. And that appraiser is going to go and he's going to value the property. It's different to what we do when we do a CMA. You know, we can do a CMA based on information we can get from the MLS. We look at sold properties, and we can look at properties that are on the market, and we can get a very good idea of roughly what the value of the property is when we're trying to list the property. But the appraiser is actually going to value the property, and he's going to say, yeah, or she's going to say this property value is, you know, this amount, and then the loan company will base their figures and numbers on that appraisal. So very good. Put some notes up here. I just covered that one. Yeah, just be aware, it can take a couple of weeks. Sometimes it can take a bit longer if we're in a busy period, which we have had in the last couple of years. So sometimes getting that appraisal done may take longer than we might consider. So be aware of that. Also, make sure you understand that the cost for this will be paid for by the client up front. They don't pay for it at closing. It will be paid to the loan company kind of immediately, and they won't send out the appraiser until they've got the money in from the client. I put a note there: realtors can contest an appraisal with good cause by appealing to the Utah County Board of Equalization by filing an appeal with the Utah County Clerk or Auditor. Has anybody had an experience where they have contested an appraiser before? We've done it twice. Once we just did it through the loan company. We showed them the comps, and the loan company said, okay, well, we'll request another appraiser to go in there and to look at this property. And they went in there, and this other appraiser looked at it and came up with the correct value that we were all happy with. Another time we did the same, that didn't happen. They said, no, the appraiser is going to stick where he is. And what he was doing, he was using track homes to compare to what we had, which was a custom built home, same square footage and same lot size, but the property we were looking at valuing was a custom built home. There's only one of them ever. It was unique. And we did have to appeal to the Utah County Board of Equalization, which took, I think, about 3 weeks, if I remember rightly. And they did come back and they overturned the appraiser's value, and he resubmitted it bang on the numbers. So I don't think he was very happy about that, but he clearly had not done his homework properly. And the comps that we said clearly showed that the value of the home was more than he had said. Anybody got any questions or comments on that appraisal process? All right. Let's see. So I've just gone through that. Try again. Yeah, you can definitely contest the appraisal with good cause. That's where you do it. Okay, good. It may go in and out of underwriting, particularly if you're with a bank or a large organization. Sometimes have a number of different underwriters that will be viewing the documents. If you're with a private company, often it will go in and come out. It may go in a couple of times, but usually it can be in and out on first and final. The final underwriting is going to obviously produce the final paperwork. All of the conditions will have been met by the client, so the underwriter will be very pleased about that. The underwriter will then allocate the funds and say these funds are going to be allocated to this account, and they'll say you are now clear for settlement. However, let me ask the question here: is it guaranteed that this loan will go through to close? Anybody like to respond to that question? I think I got a no nod from Tristan. I could just see him. Is that right, Tristan?
Oh, yeah. If you have a buyer who shows up to closing with a new car and had ordered some furniture online on their credit card, you may be in trouble.
Yeah. Has anybody had that happen or something similar to that happen? Okay. You have to just go to my stories today because nobody's got any stories. Okay, I'll give you a couple of stories. Oh, someone has got a story.
I had one that they got married.
Oh, tell me about that, Christina. That's a great story. Come on, here.
So they put the offer in, they were ready. They were both on the loan, and then they didn't qualify together, but they had got married.
How did that one pan out?
It didn't.
Oh,
right. We went right into the closing, and they're like, "Oh, we got married."
Oh goodness! I bet that was disappointing. What a shame.
Yes.
And I suppose you couldn't have even foretold that. You had no idea. It just happened.
Nope, they just figured they were gonna be living together. They'd get married and
get married, get their new home.
Yeah.
Wow. Well, we had a couple that I had one that was a few years ago. The guy he was actually from India, but he lived over here a number of years. Good credit score, everything went fine. I was representing him buying a home, and we got to settlement and all the papers there. We're going through. We nearly finish through the settlement, and then we get a call from the loan officer. It calls the escrow officer right in the middle of settlement and says, "We can't proceed with this loan." So the escrow officer calls me out of the settlement meeting. I leave my client in there. He says, "We have a problem with this loan." I said, "What's the problem?" So, well, your client has just moved several $1,000s from an account that he has in India, and we have no way of qualifying it. And it's going to have to go back into underwriting. I said, "You've got to be kidding." No, we're not kidding. So that settlement, I think, took me 3 hours because we just had to wait. We had to get all of his details. They had to call the bank in India, and I guess they must have faxed through certain documents they needed. The good thing, it did actually turn out. We were delayed and had to go through the paperwork again. And there was nothing wrong with any of the money. It was another piece of the puzzle that came into the jigsaw that they had not factored in, and the underwriter put a hold on it. So that was a rough line, but we did get through it. Some others that you may encounter is someone may not actually have the same job that they started off with at settlement. So let's say, for instance, settlement was, I don't know, maybe it was on a Friday, Thursday or Friday, whatever it may be, and you go through settlement, everything's fine, and then the underwriter calls the employer, Friday afternoon, and says, "How are we doing with little Johnny Jones?" And the employer says, "Well, Johnny Jones actually left today. We had to let him go." Well, we've been through settlement, and unfortunately, the underwriter will then stop the funds because, "Oh, hold on a minute, we've now got no job." So even though you've been through settlement, that loan package would fall apart because no employment or even change of employment. So just be aware of that. It does happen, and sometimes it can be very, very frustrating and very upsetting if we're not aware this is going to happen. So ask the questions, talk to your client, make sure they're aware of what could go wrong here. So be very, very careful to encourage them to talk to their loan officer about every step. Every little move they make in this process will make a difference to the end result. Anybody got any thoughts or comments or any other stories I'd like to share on final underwriting and settlement? All right. So we've got that underwriting done. Basically, the documents are all going to come out. We sent to title. The escrow officer there will call us up, and they'll have all of the copies for everybody. We usually need 2 forms of identification. Usually if you're buying a home, it's 2 forms. If you're selling a home, they can usually just do it with 1 form, which can just be a driver's license. And the 2 forms of identification can be, a Costco card could be a second form. They usually want the driver's license as the first. Any thoughts or comments on that? All right, so then we get the closing disclosure, all the paperwork signed, everybody's happy. So you've gone through settlement, and now we're waiting for confirmation of the funds. So the loan company has got to come up with those funds, send them to the title company. And then we get that great call that comes from the escrow officer who says, Steve, it's funded and recorded. That means that all the funding, all the money's been received from the buyer, and the title has been recorded. So it's no longer in the seller's name, it's in the buyer's name. They actually do own the home. And you get that call, we all know everybody gets paid. Buyer gets the home, the seller sells the home, and the realtor gets paid for it. That's all we need. So that's how it works. And they can get into the property. Anybody have any challenges or stories I want to share at this end post? Anybody have any problems here, or are we all good?
I just know that if you're working down more in the rural areas, San Pete County and stuff like that, if you go to settlement on Thursday and think you're going to close on Friday, most of their offices are closed on Friday, so you better plan for Monday. So that's one of those things to always worry about if you're going to work in the smaller communities, that a lot of times their recording office isn't open 5 days a week.
Yeah, I'm glad you raised that, Les, because sometimes, you know, we work on the REPC, we get all those deadline dates, and we don't think about where that actual date falls within the week. You're far better to be doing settlement earlier in the week or latest on a Thursday than moving to that Friday post, because that can also jigger you if you've got like a Monday bank holiday as well. It can kind of delay things. So I'm glad you raised that, Les. Look at it. Wednesday, Thursdays are good. Also look at the end of the month as well, because sometimes when you get to the end of the month, there's a lot of business going through these title companies, and that can also give you a bit of a bottleneck. So just be aware of that as well. Just make sure you get your dates lined up so that you are in good measure, and you don't get to settlement and think, oh, I wish I'd put this on a Wednesday or a Thursday. I'll put it on a Friday. Now we've got this happening. This could be a challenge. And most people like to move into properties on the weekends. So it's ideal to have it closed on at least by the Friday, if you can do that. So Wednesday's a good time, and Thursday works as long as you can get that funded and recorded the following day. Any other thoughts on that at all from anyone? Very good. Well, let's go into that second keyword. It's probably going to be funding on this one. There it is. F-U-N-D-I-N-G, funding. That'll be your second keyword. Jot that down. I cannot tell you what the first keyword was again, and we can't share that in text or message. But that's the second one. If for some reason you missed the first keyword, please privately reach out to Leslie Ann through the message, and she'll be able to help you. There it is, funding, second keyword. All right, let's start talking about credit score. This might be interesting for us to build our own credit, and also help in some places help our clients to be a little bit wiser. Not that we are ever going to be responsible for their credit rating, but some of these pointers might be helpful in discussion. You've probably seen that little icon that comes up, a couple of those bureaus there, TransUnion, Equifax. And basically that will be your number. That will be the score of, which is noted as your FICO score. Who can tell me what the FICO score is? What's the word FICO mean? Anybody got any idea of that? I come from England. You probably figured that with my accent. When I came over here, I had no idea what this was. And I realized very early on that it's kind of key to everything. Marilyn, did you unmute? Marilyn, did I see you unmute? Were you going to say something?
No, I need to know. I'm confused.
Good. All right. You were not as confused as I was when I came over here. I found out what my credit score was. It was 999. I thought, this is great. 999. I'm in the big deal here. I only just got here. And I figured out that 999 means diddly squat, means nothing. As soon as I got the credit score going, it went to 250, which is like zero. It's like you know, it's the same as the students get when they come out of school, 250. But they put all aliens on the 999. I guess that's so they can track them. And I found out pretty early on that this credit score was very important over here. In England, they only lend you money if you've got money. Whereas over here, they only lend you money if you're borrowing money. That's quite interesting how that works, but that's how it is. So you've got to have, and if anybody here has come into the country from another country, have to do this, they'll understand what I'm saying. You've got to have 5 different lines of credit to get this credit score going. You've got to have a bank one, you've got to have maybe a car, you've got to have some credit cards, maybe a private company like RC Willie, buy a TV on there. You've got to have about 5 different lines to get the thing going. So I figured out this early on. I went to the bank, I got an account with US Bank, and I thought, okay, I need to get a loan. They're not going to loan me any money, but if I give them $1,000, then maybe they'll put that somewhere and loan me $1,000 so I can get this credit score going. So I went in there, saw the manager, told him what I was doing. He says, oh, okay. And then he said, why don't you just use $1,000? I said, well, I want my credit score. I'm at nothing. I'm at 250. Oh, he says, okay. So off he went into his little office. He comes back. You'll laugh at this. He says to me, we can't loan you any money. I said, but I'm giving you the $1,000 cash. There's no risk. He says, yeah, no, I can't quite understand that. He said, but the system won't let me loan you any money. I said, well, why is that? It's because you haven't got a credit score. So, okay, then. So that was that. Then someone told me, go to the credit unions. They might be more favorable. So I went to Cyprus first. Same scenario. And they come back and say, oh, yeah, as long as we can have your cash and put it somewhere you can't get hold of it. I said, that's fine. We can lend you $1,000. I said, okay, great. I did the same with Mountain America. They did the same. So the credit unions are a little bit more flexible. If you've got young people that need to get some credit going, encourage them to go to the credit unions because they will lend them money easier than the other mainstream banks. So I got 2 lines going on there. I get the mail that says, we're a credit card, we'll give you $500. So you sign that off, you get that one. Went to RC Willie, got a TV. They're quite good at giving you credit, to be quite honest. So I built up my 5, and within 6, 7, 8 months, my score was well in the 500s. So it does work. So we'll talk about that process and some of the things you might want to look at when you're working with credit scores. All right, so yeah, here we are, the FICO credit score. I'll talk about how it's compiled. We'll talk a little bit about how it's going to affect your loan application, and we'll give you a few notes on how you can repair it. So, anybody know what it stands for? Anybody here know what it stands for? And it's okay if you don't, because I had no idea either. But it's pretty important we understand what this is. So I'm going to give you some history on this. It might be helpful. So the legal name is Fair Isaac Corporation. Originally, it was called Fair Isaac and Company. It's a data analysis company based in San Jose, California, basically focused on credit score services, right back as 1956 there. And it's now a measure of consumer credit risk. It's become a fixture of consumer lending throughout the United States, all from Mr. Bill Fair and Earl Isaac there. So now basically it's probably even higher now than 90%, but 90% of top lenders are all making their decisions based on this FICO score. And whether you're getting a home or a car or special purchase, basically these credit unions are going to be helping you get your score up to favorable platforms that you can qualify. So here are some thoughts we'll go through. Currently, the FICO score 8 is the most commonly version. That's the up-to-date one that companies are using. And I'll go through the rules on this, which may be helpful to you when you are thinking about people that, you know, got to repair their credit. Okay, what have we got there? Card utilization. Oh yeah, okay. So I'm going to talk about card utilization, percentage of on-time payments, average of age of open accounts. Will all kind of play a part in making this thing work. So have a look at this little graph here. And basically this FICO score 8 is based on these 5 different blocks. So 35% of your FICO score is going to be based on your payment history. We'll look at that in a moment. 30% is based on what you owe. You've got 15% that's based on your credit history. That's how long you've had that credit open for. 10% on new credit, and 10% is on the mix. So that's what we'll have a look at, see if we can learn something today. And just stop me if you've got any questions on this, or I'm talking too fast or too English, and I'll repeat it again, hopefully to keep you with me. So let's look at these little blocks and see if we can figure out a little bit more on how these are built. So we'll start off with the 35% payment history. So this includes your late payments. It also includes any collections. Unfortunately, they do happen from time to time, any past due accounts, and of course, any public records. So that 35% chunk is going to be nosing into those 4 areas. So if you're not on any public records, you've got no past due accounts, you've got no collections, you've got no late payments, then that 35% is going to be fairly good for you, give you a clean bill of health. If you have any of those areas, it's going to start to chew into it and reduce your score. So then we've got 30% based on how much or what is owed. All right. So this is the amount that's owed on all of your accounts, number of accounts that carry a balance, percentage of credit being used, and the balance versus available balance. That's really important. We'll look at that a bit later on. But 30% of that FICO score is going to be based on those 4 areas. So how much is owed, and that's not just one item over the lot, it's all individually based on each card. If you're on credit cards, for instance, of course you may have maybe student loans or mortgages or car loans or whatever it may be, but they're on each individual piece. And then you've also got how much of that credit is being used. That's key, and we'll talk about that as well a little bit later on. Then we've got the length of credit history. So how long you've had the credit for, how long you've been paying your bills on time, time since you've opened an account, time since recent account activity, and acquiring a new card if good credit. So let's pause there for a moment. Anybody got any questions or comments on those 3 areas? Okay. So I had a realtor on this class a couple of months ago, and she said they were a bit gutted because they were in the 800s and very, very good credit score. And they've been in the 800s for a few years. And then she found a credit card that they just don't use. And she'd had it for 22 years, this credit card. And she decided, well, we don't use that credit card. Let's just close it and be done with it because we don't use it, which is what she did. And it took her credit rating, and this was some years ago, I'm thinking like 2, 3, 4 years ago, took her credit rating into the mid to late 700s. And she has not been able to get back into the 800s. So that 15% may only be 15%, but if you've got some credit cards that you're not using, but you've had them for a long time, I'd encourage you to keep them, because that length of credit history can certainly help your credit score. Any questions or comments on that slide?
I have a comment about that, actually.
Oh, fire away, Liberty. It will take Marilyns. Fire away. Thank you.
So with the credit cards, I had some like through clothing stores, and they were building up my credit for a really long time. And then I went 2 years without using it, and it canceled the card, and it actually dropped my credit like 30 points because it stopped that building. So you have to use the
well, usually, Liberty, they'll send you well, there's 2 ways in which to do it. generally speaking, they'll send you a little letter that will say, hey, we notice you've not used this credit card for so long, and if you don't use it in the next 30 days, we'll cancel it. Most of the mainstream credit card companies will do that. However, there are some, and I think some of the stores fall into this category, where they have in their terms and conditions that nobody reads, of course, they have a little note there that says, if this card is not being used for a particular time period, it will automatically close within 30 days. So thanks for highlighting that, because it is a good idea to check and see what you've got, because even though you may put that, go back to that department store and get another credit card, it starts from zero. You've lost the history part, and that's why your credit score dropped 30 points or whatever it was. Thanks for highlighting that, Liberty. Good job. And Marilyn, did you have a comment you wanted to share? Oh, you're on mute at the moment. Marilyn.
Sorry. Are you telling us it's better to tell clients to hang on to all of their credit cards, even if they aren't using them, keeping them? So
here's the thing, make it quite clear that we don't give anybody financial information or financial, because we're not finance
no
gurus, okay? But if your client said, I'm trying to get my credit score, you may say, well, here are some pointers that might be helpful, because this is how it works, all right? But you're not giving them financial advice. But the bottom line is, Marilyn, you're absolutely right. If they've got some cards there that they've had for many, many years, and they're not using them, they're probably best to keep them, because it will help keep that FICO score up.
Okay. This is for a son I was thinking about, so not a client.
So here's another thought. I'm glad you mentioned that, Marilyn. And there are some people, and we're always wiser when we get a bit older. This is certainly, I've learned this from some people. What they've done is they've put their children onto one of their credit cards early on, like when they're 12, 13, 14. And what that has done, that started to help that that child gain credit on their personal account. So when they get to a stage where they've got to get their own credit, they've already got some credit rolling in that's attached to their name. So that may be something you could look at doing. But I know people who've been on this class have told me that that's what they've done. So that may be helpful. Anybody else got any thoughts or comments on that slide?
Yes,
yes. Thank you. Who was that speaking? Someone did start speaking.
It's me. Sorry, I pressed on it again. If you're working with a good lender, they can give advice. We as realtors can't. We can give general ideas, but if they're working with a good lender, that lender should be able to look at their profile and tell them if they need to close any cards or any accounts and what to do. They're your go-to. So if you're kind of worried about your FICO score, or if you're trying to get a credit score to a certain amount for your loan, if they're a good lender, they will have that information, or they will know someone that they can refer you to that can really help you get your credit score where it needs to be.
Very good. Thank you, Leslie-Ann. And as Leslie-Ann just said, these loan officers are doing this all the time, and they are always giving good advice to the clients. So very good. Let's move on to that next screen to see those other two areas there. So we've got new credit. So best have a mix of new credit. If you want to push it up, certainly if you've got a client that's just moved into the country, or a young client who's just come out of school, this is where they've got to start, is to try and get a little bit mix going on. I just put a note there. You can still make this work, because we didn't have a mortgage. It was all small amounts that were going through, loan or credit companies, but we didn't have a mortgage, but we were still able to push those credit scores up. I put a note on here that department store credit cards and finance companies are considered low quality credit, just so you know that. You got your, so that was your new credit. This is your mix. You got your new recently opened accounts and number of credit inquiries, just be aware of that. And then time since each account was opened, and how often you apply for credit, and whether they're soft or hard or auto inquiries. So that's kind of how that mix works, and that's how the credit works. So that takes care of those other two blocks. So let's see if we can chew this down a little bit and see if we can learn something. So at the moment, this is how the scores pan out with this FICO score 8. 580 is poor. It's sort of the risky borrower platform. And then as these follow up, let's see if I get that next one coming in. Oh, okay, I must have got stuck there. Let's see if I can just load that in again. Not sure why that got stuck. Maybe it's a connection. There we go. You got your fair up to your 669. You're good up to your 739. You're very good up to 799, and then 800 plus is your exceptional. All right, so that's kind of how those figures work at the moment. Most lenders are going to approve the 580 upwards. Like I say, I'll put many there, but most of the private companies are going to be able to help you even if you're only at the 580. Let's look at how this is put together. So this is important. So we'll start off with the credit card use, which is obviously high impact. And as you can see, the credit card use works on a percentage. That's how it's reported. And you can see up to 29%, you're in the green bars. All right. So this matters. So if you've got 10 credit cards, we're talking the percentage on each one. So say, for instance, you've got one credit card, you've got $1,000 on it. Then if you're spending, or if you've got up to $290 on that credit card, you'll be in the green. If you've got a credit card that say $10,000 limit on it, and you spend up to $2,900, you still be in the green. You see how that works? So what they're basically saying is if you're spending, or you're keeping your spend power under like that 30% margin, then you're going to be good. I mean, you can go up to the 49 to be in the yellow, but that's still a bit iffy. If you want to be in the green bar, you've got to be under the 30% of whatever you've got on your credit cards. So if you add up all your credit cards together and you've got $100,000 of credit there, and you're spending under 30,000 on the credit card, to make sure that's under 30% of each of the credit cards. Does that make sense? Everybody got that? Oh, I talked a load of gibberish here. Please give me some thumbs up if you understand what I'm saying. Okay, I got some thumbs up. Good. I can't see everybody. There you go. All right, so let's just load these in and see if I covered that one. Okay, yeah. So here we are. I was going to load this in and then we'll talk it through. So banks usually share your information on a particular date of the month. It's probably not the same date you're paying off your bill. So sometimes you can pay off your credit card and that doesn't show with the score until it's gone through the second cycle, because the bank has a different date to what you have. So if you're paying off credit and you keep looking at it, it's not moving, it's probably because you've just missed the date, or the date is too far out for it to record your payment. So that's why you'll sometimes see a difference in your credit card information changing on the money that you're paying off. Any questions on that slide? So the key thing in this piece of the puzzle is to stay under 30%. That will help you. You're better off to have multiple credit cards and stay under 30%. Let's say, for instance, you've got 10 credit cards and you've got $20,000 credit, and you're staying under 30% on each of them. That's much better than having one credit card that's got 20,000 on it and you're paying more than your 30%, or you've got more than your 30% on the balance. Okay, let's look at the history. So history is important, and there's not much here. It is a percentage. So basically you only really got 2 percentage points here before you get a little bit of a ding on that 98%. So a single 30 or 60-day missed payment, easy to recover, but it may hurt or hit your credit score. Certainly 90-day missed payment is going to damage you, and it could disqualify you from certain loans. After 90 days, payments can become charge-offs, sent to the collection agency, which is going to give you a bit of a ding. And this is kind of how it works. I'll just load this in, and then I'll be able to explain it to you. So this percentage follows a formula that includes all the possible payments you can make across all your reported accounts. For example, if you had 120 possible payments in your credit history, having 3 late payments during that time period, whatever the period was, the calculation would be as follows. So 120 minus 3 would equal 117 divided by 20, which would put you at 97.5. You see, that would give you a ding. You'd be under the 98. Any questions on that one? I went pretty quickly on that. Any questions on that previous slide? All right, let's go to derogatory remarks. These are in high impact, and so you've got a client in here that will need to probably spend some time with your loan officer to have time to prepare. Oh, let's put a note on that slide. I'm not sure where it's not loading in. It probably is loading in, just slow. Let's see if I can load them in. Here we go. Let me load these in first, and then we'll talk about them. Okay. So a derogatory remark can stay on your account for about 7 to 10 years. So that's a tough run. And you'll find most of these serious areas are on your account for 7 years plus. Debt collectors need proof of information. You should dispute anything if it's not accurate. So if you've got a client that finds that something's not quite right with the debt collection service, then make sure they dispute it and get it right, because it will make a big difference. Make sure they understand their rights. Debt collectors cannot just keep calling them. You know, you can put in play platforms that will stop that if you are, or don't let them get bullied. That's the bottom line. Unfortunately, the Federal Consumer Financial Bureau has excellent resources for debt recovery. They'll just keep at it. So make sure they understand their rights. If you've got an old debt, don't necessarily pay it off. Talk to your loan company. Sometimes it's better for those just to fall off the account. Public records like bankruptcies and civil judgments, tax liens, public records are much harder to remove. So take a bit of time. If there's any information incorrect, though, make sure you get the correct document, get the court to rebuild your case and to reverse those all that information. And you can certainly dispute with the credit bureaus to remove the public record, which they will do if they've got the information. Any comments or thoughts on that screen? Okay. All right. Let's go through these, because these are just important information for us to know. This lady looks a little bit depressed. Maybe she's got one of these. Let's see what we can do to help. So a tax lien, who can tell what a tax lien is? Let's see, we got Steve. You want to tell me what a tax lien is? You aware what that might be?
Unpaid tax and lien on the property.
Mm-hmm. That's right. Sometimes they'll remain there for a long time. Even sometimes they don't come off. But generally speaking, once they're paid off, it's 7 years. As for the bankruptcy, who can tell me what bankruptcy is? Let's see. Sarah, you want to have a crack at that one? Not bankruptcy. Have you come across that one before?
I know that there's a chapter 13, right? And then there's chapter 7. And I believe it's the chapter, one of the two falls off quicker than the other.
Okay, so basically, running their own company, and the company goes into bankruptcy, they can't pay off, the creditors. So the courts rule that it will go into bankruptcy, and you know, I guess the debt is cleared in a sense. They don't have to pay anymore, but they've got no business. That's basically what we're looking at there. So you've got 10 years from the discharge date on those bankruptcies, which do also include those numbers you mentioned. Oh, I got stuck again. I may have to load this one in all the way. Let's just do that. Then we've got the foreclosures. I'll just load these in. We'll just go through these, make sure everybody knows what these are, because sometimes they pop up. Whoops. I do apologize. Happy clicking here. Let's go in again. All right, let's go to, I think there's 7 of those. There you go. Let's go to foreclosures. Who can tell me what foreclosure is? Les, do you want to tell us what foreclosure is?
Yeah, foreclosure is just the process of the bank taking back their property that wasn't paid for. So it's your inability to make the payment, so they take it back.
Yep, unfortunately that sometimes happens. So they foreclose on the house. And often, stay with me, Les, often this can take a period of time. It's not a quick process, is it? Often the banks, the lender will give you
it might take a bank 2 years to fully foreclose on a home because they'll put out a judgment for it, and then it has to go through the public announcements, and there'll be some appeal somewhere, and it just prolongs it. Sometimes it goes really quick, but most of the time it's not very quick on the foreclosure side of things.
And so if you've got a client that's working on it, sometimes they can pull out before it actually forecloses. So as Les said, it is it can be a long process. Judgments, what might they be? Anybody got an idea on judgments? Marilyn, do you want to chime in on that one? What sort of judgments might be? Any idea on that? Oh, you're muted, sorry.
So that was, I don't know why I keep having a problem with that. I figured that's the one you'd ask me, because I'm thinking, I have no idea how the judgments are considered.
So good. So really, is any judgment from a court? It could be a simple thing like, you know, I don't know, someone's not paying child support or something, and there's a judgment against him. So it could be any judgment from the courts that involve money.
So they're more minor than a bankruptcy or foreclosure then.
Well, yeah, it would depend what it is, of course. I mean, there could be some judgments that could be embellishment of, I don't know, funds from a company or whatever. It could be big amounts, but yeah, it could be minor. You're absolutely right. Let's go to charge-offs. Anybody got an idea what charge-offs are? Who should I pick on for charge-offs? Tammy, how about you? Do you want to see if you have a crack at that one? Sometimes most people don't know what charge-offs are. Let's just see if Tammy.
Okay, is a charge-off when the bank writes off the delinquent debt?
Okay, yeah. So the creditor, the person that's loaned the money, right, who's wanting the money back, they chased their client for so long, they thought, you know, we will just call it a day and we'll charge it off, but we are going to log it. So maybe someone's had their, I don't know, it can be anything. They could have had their roof repaired, or they could have bought a car. They could have done anything, but they stopped paying it, and they keep chasing them. And eventually the company goes, okay, we'll just charge it off. We'll just call it as a loss. We won't chase them anymore. We'll call it, because it's costing us too much money to chase. The vendor decides they'll just charge it off, but it was showing up on the report. Very good. Well done, Cammy. Collections. Anybody? Well, collections are obviously collections, you know. Anybody want to respond on that one? You go into collections, you're usually on that after 90-day platform if you're trying to pay off whatever it is. And then anything else, of course, is 7 years from the last day. Negative activity. I thought there was one more in here. Oh, there isn't. Okay. All right. So let's look at credit age. As you can see, once you've got credit cards that are after 7 years, you're starting to get some nice green bars on those. It's a medium impact. It's not a big deal, but it is a big deal in the whole scheme of things. So usually at the moment, the average age of open accounts is 3.5 years. So it's good to know that. Don't close your oldest credit card. What gives you the longest history? We covered that. Liberty shared that note on auto closing, so be aware of that. Fall offs. This is, you've paid your mortgage off. That'd be nice, wouldn't it? We'll pay our mortgages off. And then it drops off, it falls off, or the student loan falls off, or whatever it may be. You've had your RC Willie furniture, and then it falls off. So when it falls off, that will also kind of hit this credit age department. Any questions on the credit age? Just keep those old credit cards or keep those old credit accounts if you can. They do give you a bit of impact. Low impact total accounts. So looking at all the accounts together. So if you've got more than 11 accounts, that is quite nice for you. So generally speaking, you'll see, if you look at your credit score, you'll see something like this. It will show so many open accounts, so many closed accounts. And basically, as you go through your accounts, if you can keep at least 11 open, you'll be in good shape. Not sure why that one stopped. It did. That one. Rolls in now. That's funny, isn't it? Okay, I'll roll these in and then we can just review it. So I mentioned earlier, have at least 5 credit accounts. Could be credit card, bank loan, car loan, mortgage, private loan company. And within 6 months, if you're working with a client at the moment, maybe rented a property, and they think, and you've approached them and they say, well, we'd love to get into a house, our credit score's not very good. You could say, hey, try and get 5 or 6 credit accounts going. And within 6 months, you'll probably see a difference in your rating. And then once you've got that, we can have a chat. In fact, maybe I can just get you locked into one of my loan officers who can start to help you through this process. But give them hope that, within half a year to a year, they can be in a position where they can actually, probably get into a home. I'll put a note there. Lenders like to see that you use a variety of accounts responsibly. Okay, hard inquiries. Let's look at these. Generally low impact, but we're really looking at only a couple of these in a year period. So they can give you a temporary ding, but usually within 2 or 3 months that will bounce back. I put here minimize hard inquiries at 9 to 12 months before trying to get a mortgage or a big loan. So, because obviously that's going to be a hard inquiry as soon as you start working with a loan officer. Can stay on your report for a couple of years, but will disappear over time. I'm not sure why that one got loading either, but I think we'll pull out. Pull it to this next one. Okay, here we go. So these are what we would generally call hard inquiries. Obviously for a mortgage, if you're applying for a personal business loan, an auto loan, obviously for a credit card. And this is one that people sometimes forget, but if you're asking for a credit limit increase, whether it's a credit card or any other type of loan, that will also be a hard inquiry. And sometimes these will just happen online, so be aware of those. You can go online and put your numbers in, and then it'll automatically do a hard inquiry. Applying for a student loan, of course, and here's another one, apartment rental applications. So if you had a client who's moved from one apartment to another, maybe several times within a year, that can have a little bit of a ding on their credit rating, so be aware of that. Here's a good one, collection agency skip tracing. Anybody got any idea what that is? I won't pick on anybody on this one because most people don't know what this one is. But is there anybody that does know? Okay. Basically, it's when someone is being chased to pay their bill and they disappear, and then they move out of state. They've still got this, I guess, loan or debt outstanding with a company or whoever, and the agency apply what they call agency skip tracing. So they have people that will go from places, a bit like a detective platform, really. They'll go from where you live, they'll find the next place, and they'll eventually catch up with you. And when they catch up with you, they'll be asking for that money back. But it's called collection agency skip tracing. They lock into agencies all over the country to do that. So sometimes it can take several months or years to catch up with the debtor, but that will definitely give you a ding if you are on that. Whether they've caught you or not, they're still going to apply a ding to your credit. All right, let's move on then, and we'll look at a few more thoughts on the hard inquiries. So some people ask, what do they actually show? Well, basically, hard inquiry often show everything on your credit score to the negative. All right, so it will show everything that's available there. I don't know why these aren't loading into there. It's really strange. Maybe my internet's down. I've got to load them in quickly. There we go. All lenders will most likely do a hard pull on your credit before they're going to give you any money. Hard inquiry will show everything to do with your credit history, such as current financial behavior, your payment history, your balances on your loans and your credit cards, etc. Hard inquiries will remain on your credit report for 2 years. So that's your hard inquiries. Let's talk about soft inquiries. I'll just load these in. Oops, that's really strange what's going on with my machine today. Oh, let's try it again. Let's just roll these in. I'm not sure why. Just be patient with me, guys. Technology. I'm going to load these in. Maybe I've lost a connection or something. There we go. So soft inquiries, not linked to specific application for new credit, don't really affect your credits. So these are good. Giving permission to a potential employer to check out your credit report is often a soft inquiry. They'll just do that and it won't bother your credit whatsoever. Pre-approvals for offers from lenders such as insurance companies or credit card companies are soft inquiries, do not affect your credit rating. So particularly if you're looking at buying a car, often you'll say to them, it must be a soft inquiry, because they can run soft inquiries because you may be running from one auto company to another. You don't want to be building hard inquiries. When they actually finally do the proposal for your loan for the auto, then that will be a hard inquiry. So just make sure if you're looking for a motor, that you work with the soft inquiries. Just something got to remind them. Let's see if I just load these in quickly. Okay, so obviously if you're checking your own score, and people do that all the time, you can do it with banks, or you can do it with Credit Karma, or whichever platform you're using. That's going to be a soft inquiry. It's not going to impact your credit. Getting an insurance policy would not impact your credit. Of course, I mentioned your employer background will not. And also, if you've got these credit card pre-qualifications that occur without an application that often you do online, that also will be a soft inquiry. If you're getting utility or internet or cable account, that will also be a soft inquiry. And just stop me if I'm going too fast, guys. If you have any questions on these. Some people ask the question how these will actually show. Well, they're going to see more or less what you see on your own report when you look at your own credit report. It will just kind of show lines of credit, it will show your loans, any collection accounts, it will obviously refer to your payment history, Employers, credit card companies, insurance companies can all pull a soft inquiry without your permission. Just be aware of that. But it will not give you any dings, so that's all good. That comes up to our third keyword. And as we get on to the last third on this class, third keyword is going to be the 5 do's. 5 things we should do. So write that down. If you've missed either of the other 2 keywords, please reach out to Leslie Ann. Please do not share them in the chat. You're not allowed to do that, and I can't repeat them. But I can tell you that the other 2 keywords did begin with an F. All right, so there. That last keyword is going to be 5 do's. Okay, 5 do's. Anybody got any questions on anything we've said so far on the credit rating? Anybody learn anything new on the credit rating that they'd like to share or highlight? I'm not doing very well. Nobody knew it. Nobody learned anything.
I was surprised. This is Kaylin. I was surprised to know that they want you to have, like, having 11 or more accounts is better.
Yeah, thank you.
It seems really high to me.
Yeah, it does. It does. But that's if you want to maximize your credit rating, that's what you do. I like to see that. That's just the way in which this FICO Score 8 rule platform works. And you can go to their site and you see exactly the same, because I've only got that information directly from them. Yeah, 11. It's interesting, isn't it? But actually, most people have probably got at least half a dozen different lines of credit. But yeah, if you can get to that 11 plus. And what I say to people is, look, you know, if you've got a credit card, you don't use it very much, that's fine. Just keep it open. Just put something through it, maybe every 6 months. Just put a fuel bill through it, or maybe, you know, buy something off Amazon. And just keep it open, because that'll certainly help you. Anything else that was highlighted that you didn't know or was new to you that you'd like to share? Okay, let's look at some 5 do's. And these are just things we can say to our clients. These are good things to do. Let's see if I load these in. Oh, really having a challenge today. I'm going to have to try that one in again. Let's try it in again. Let's try and load that one in again. I'm not sure why it's not loading in. Let's just load these in, and then we'll just have a little chat. So, it's a really good idea to check your report periodically, whatever's good for you. So at least you know what you're working with. And this also enables you to see how your credit score will change when you're doing different things. So you can try some of these things we've talked about today with your own credit. So I'll just give this a go. Maybe like, was it Christina that said about Caitlin, wasn't it, who said about the 11 accounts. Say, for instance, you've only got 7 accounts. You may think, you know, I'll just get another 4 accounts when they come in, when the mail comes in and says, we'll give you this. I'll just try it out and then see at the end of the year if your score has gone up. So it's a good idea to check your report periodically so you can see what you're doing that's making that report more favorable. Obviously, paying bills on time or early is, you know, the green light. That's going to help you big time. If you've got any past due accounts, then just let's get them paid and then keep them current. Now, here's a question on that one. If you've got some past due accounts, so say for instance you've got 3 accounts that are past due, and one of them, let's say for instance, they've all got different amounts owed on them, and one of them has a much higher amount owed than the other 2. Is it better to put all your energy in paying off the one that's got the most that's owed, or is it better to pay off the 2 that have got the least owed? And we've got any idea how it might be best to tackle that? Tristan, what would you do?
Say that again, Stephen.
So Tristan, if you got, say you got 3 or 4 accounts, one of them, say they were credit card accounts, all right, one of them had quite a high balance on it, and the other 3 had smaller balances, and you got your money. Is it better to throw it all in and pay more of the one that's got the higher balance off, or is it better to focus on the smaller cards that you could clear?
I think it would be better to pay off the card with the higher balance to bring that down below, say, a 30% limit. I think that would improve your credit overall.
Yeah, that's what you would do. You go for that 30% limit first. And once you've got it under the 30% limit, the next thing will be to try and clear the smaller accounts, if that makes sense. Because then what you've done, you've brought it under the limit for the overall credit, which is high impact, and then you're getting rid of the amounts that are showing on the small accounts. So you're eliminating them. You tackle the one that's got the least amount on first, you get rid of that one, because then that's going to give you a higher increase in your numbers. Some people think, oh, I've just got to keep working on the bigger amount, but not so. If you can clear some other debts off that are smaller than that, it will reduce the amount of accounts you've got that have got debt, as long as that the bigger item is under the 30%. Very good. And then, of course, we talked about, keeping your cards active, putting something through there every 6 months will keep them going. Any thoughts or comments on that slide? Or observations or add tos? All right, let's go to the next one. Now, these are the 10 don'ts. So I'll just load these in case I lose a connection here. We'll load the first 5 in. So obviously, right from the outset, if you've got someone working with a loan officer, ask them, don't do anything unless you talk to your loan officer. Okay, that's really important. Just talk to your loan officer. Closing credit cards, don't just do it automatically. Talk to the loan officer. He or she will tell you which ones to close first. Obviously, don't max out any of your cards or overcharge. Overcharge is worse than maxing out, but don't do either of that. It's real easy to get pre-approved for credit cards, and sometimes when you're in the process of clients in the process of buying a home, these might turn up and look very favorable, and they may slow the process down if they apply for them. I had a client, I think it was last year actually, buying a house, credit rating was great, everything was going through, it was a smooth transaction, everything was looking good. We got to the week of settlement, and it was actually before settlement. We got the settlement sort of planned on like the Thursday, and I get a call like on the Tuesday from the loan officer telling me that we cannot do settlement on the Thursday. I said, why is that? He said, well, your client has just opened up a credit card with the store department. I said, really? I told him not to do that without talking to you. Anyway, I spoke to my client. He says, oh, yeah. He said, I clearly didn't think. He says, I was in, it was either JC Penney's or Coles or somewhere, and he's got his merchandise and he's at the till, and the lady says, would you like to put this on a credit card and get an extra $30 back or something or other? He says, yeah, great idea. So he fills out the form and off he goes. He's got his merchandise a little bit cheaper. He's happy. Everybody's happy except the loan officer is not happy. And that delayed us, I think, another week and a half in order for us to put that through the process, put it through the system. So we had to delay, and we had to delay our side and delay the other side in order to make this thing work. And it was just a simple mistake that he just overlooked. In his mind, he wasn't applying for a credit card. It would happen in the store, and the teller just gave him the offer, and he took it. So just be aware of that. Any questions or comments on that one, or thoughts? Okay. Here's another big one. Consolidation. So sometimes you'll get something that comes in the mail and it'll say, hey, why don't you put all your credit together? You'll pay less a month and we'll look after you. That's a big no, because if you're in the middle of a transaction, that is definitely going to hit the underwriting department, and it could even stop you from getting the loan. So don't consolidate anything. People, the credit cards going as they are, even though, you know, there's probably some debt you're working on, which is fine. Old collections, don't just pay them off. Talk to your loan company or your loan officer and say, you know, it's a good idea to pay this off or not. They'll probably say no. We'll just let that, you know, drop off there, and let's deal with these other more important areas beforehand. Here are the next 5 in this 10 section. I'll just load these in so I don't lose a connection there. So here's another easy one that sometimes can be done without thinking. You know, a family member says, hey, we're also getting our house done the same time you are, but we just need someone to co-sign, and the rest of the parents or the grandparents can do this. You're able to do this. Yeah, we can do that. Well, don't do it. Don't co-sign for any other loan when you're working through a loan process. Large deposits. Don't make any large deposits into any bank accounts. Wait till after you own the home. Don't change any bank accounts or open a new bank account. That can also be a challenge for you. And employment, we talked about that one early on. Don't change your employment, or don't decide to become self-employed on the week of your settlement, because that could also give you a challenge. And don't go to RC Willie and buy a load of furniture on the way to settlement, so that when you move into your home, you're all ready to go. Anybody had any stories or experiences I'd like to share with some of our new agents where they've had to deal with some of these top 10 don'ts? Oh, silence. There's nobody. Someone should share. Was that you, Marilyn? Fire away. Maybe it's just me and you that are focused at the moment. I'm just joking.
I have
anything to share on that? Yeah, fire away. Thank you.
So I had a client that I was helping buy a house or sell. We sold her house first, and then we wanted to find, obviously, a new home for her. But we had to get under contract quickly. However, processing her financing to show that her mortgage was paid off was such a tight frame with our due diligence and our closing timeframes that we had to put on paper in order to win the contract. So that was kind of intense, but my lender was able to pull through it. So it ended up working out, but I put him under a lot of pressure to get that done because he had to resubmit everything, and so that was paid.
Yeah, and when you're working on those crunch items right at the end of the transaction, it's really good to have a lender that you can connect well with and keep this thing going, because sometimes it can be very frustrating for everybody. Frustrating for the lender, frustrating for us, and of course frustrating for the client, and frustrating for the other party that we're working with. You know, if we've got the other agent that we're having to, you know, extend things or delay things, it'd be very stressful. So the key thing here is just to keep ahead of the race.
Well, and that's why I don't discourage my clients from working with banks, but I always tell them that customer service isn't necessarily their first priority, whereas loan officers, independent loan officers, you know, realtors are their bread and butter, and so they're going to tend to your needs. They're going to make sure that they get everything done in a timely manner as best they can, whereas banks, you can't really depend on them to do that. You don't necessarily have that kind of relationship with them. So
also banks tend to work Monday through Friday 9 to 5, whereas a lot of excellent lenders will answer your questions, your calls, evening and Saturdays.
Absolutely.
Yeah, and the banks are great if they've got products and you can check all the boxes correctly and you fit them perfectly well and there's going to be no challenges. They're fine. It's just when you've got difficult files, often the private companies, because as Sarah just said, because they've totally invested in making this, they'll look at ways to make it work. But sometimes because the departments are so big in the banks, they just come back and say, oh, we can't do it. So yeah, that's your difference. Very good. Thanks for highlighting that. Very good. Anybody else got anything to share or comment on before we wrap this little lesson up? Okay, so let's look at what we've covered today. We looked at the loan process, and of course we went into some detail. Actually got that right loan officer, match him up properly. There's going to be a conversation with him or her. We're going to go through the loan application, and my machine has stopped, so I'm going to put it on this one, see if I can get this to work. I don't know why it stopped there. Let's just try one more time. If it doesn't work, we'll just go on that other screen. Oh, here we go. We talked about initial disclosures, the documents, of course, lots of documents sometimes, particularly for self-employed folk. First round of underwriting, we talked about the appraisal, we talked about the final round of underwriting. Got obviously those closing documents, signing with title, we get the final sort of disclosure and the funding. We went through the credit score, talked about what the FICO credit score was, how it was compiled, how it affects the application for credit. What we can do, some of the things we can look at doing to hopefully repair that. We reviewed those 5 things to do and the 10 things not to do. Anybody got any questions or observations or highlights they'd like to share as we wrap this class up? Very good. Hopefully you learned something today, and just remind you from the outset, we don't give any financial advice, but we can definitely encourage our clients to find out for themselves how they can improve their credit, and we can give them some pointers. You know, once they're working with a loan officer, we would encourage them to find that extra help from them or from a financial advisor that focuses on this all the time, because each application is different and personal to their circumstances, and what works for one may not necessarily work as well for another. All right, so there we have it. If you didn't have any questions, Leslie Ann, I'm going to hand over to you with a fraction